All right, so now begins the four buckets. All right, so let's look at taxation. Now, this is where I often see the first mistake. You don't want retirement income, you want retirement cash flow. And this makes all the difference in the world. When you're coming down the mountain, you're going to be faced with four different types of taxation. And let's draw these out as buckets. This first bucket is ordinary income. Now, the best example of this would be if I had income from a business, from real estate, from like W-2 or a 401k or IRA distribution. And let's say that you had $80,000 of income distributed from this. Now, let's say in your first year of retirement. Now, the first thing you need to know is the entire 80,000 of this is taxed. And the second thing, it's taxed at the highest rate in tax code, which is ordinary income rate. And the third, you're going to have to pay two entities, both the Fed and the state. Now, California is sitting, like 13, 14%, on top of your federal. So this is a crazy bucket to be distributing from if we're wanting to come down the mountain efficiently. So according to today, if they don't go up, which we know they will, so this 80 grand, we can anticipate potentially kind of at most maybe 30,000 in taxes. So this would leave us 50 grand of spendable income. Now, this is when it takes an interesting turn, and it's an eye-opening thing for me. The government has decided that if you have $50,000 of retirement spendable income from bucket number one, then you are rich beyond your wildest dreams, and therefore you don't deserve all of your Social Security. So with 50,000 of income, the government will tax 85% of your Social Security, meaning they take 85% of the benefit and they add it back to the top of your gross income distribution. How's that make you feel? When do you think people discover this fact? You're absolutely right. It's when they're at the top. So this is a forms of means testing. The government says if you have other forms of income, then you don't need all of your Social Security. So they take it from you. Now, I've already explained why this one really frustrates me, because this is double taxation, each at the highest tax rates allowed according to the code. And personally, I think that's why we should be in revolt over this thing. And now I'm confident you're not going to need your Social Security. But you already explained that if you could get 100% of it back, you would. And to that I say, heck yeah. So let's move over here to bucket number 2. This is the capital gains bucket. All right, so this comes from selling business or real estate or other investments, etc. Anything that's not wrapped up in a qualified plan. Now, let's say that you took this same $80,000 income during your retirement. Now, the difference between these is that they don't tax the entire 80. They tax just the gain. That's why they call it capital gains. So to figure out how much gain you have on the distribution, your CPA is going to ask for your cost basis. Now, what that means is what you paid for the asset originally, or your total contributions. All right, it's not what it grew to. So let's assume that half of this was your contribution and half of it was growth. So because it's 50-50, they're going to take half of your distribution, and this is a return of your cost basis, and this other half, this 40, is considered your gain, and this is what you have to pay your tax on. So the cap gains rate is lower than the ordinary income. So we normally use in the industry about a 20% tax rate for cap gains, but we know it's just another funnel that they get to turn up and turn down as they wish. Again, they control the terms and they controls the rate, as I call the knife. So on this, you would pay an estimated of 20% of that, so $8,000 of tax, which would leave you with $32,000 of your gains post-tax. Now you did get to keep the $40,000 of your cost basis, so you actually have $72,000 of spendable income. So your gross distribution was the same, but your spendable income was substantially. It's about a 60% increase. Right, so this is a more tax advantageous bucket. That's why some people call it the most advantageous tax in all the tax code. But where do you think most people have all their money? You're absolutely right. Over here. The majority of it, actually. Now, the government's done a fantastic job of pushing people into bucket number 1. Right? They love this bucket, and they've done a fabulous job. And certainly has the financial service industry, because one, with the government, you can't touch it till you're 59 and a half. And the financial service department market loves that, because, then they have that money for a long time because you can't touch it. Now, there's something happening here that's interesting to me. The $40,000 of cost basis does not hit your 1040. It doesn't go forward to your 1040. Only the $32,000 does. And only on that 1040 is where they do the means testing of your Social Security. So if you show $32,000 of taxable income, they're not going to tax 85%, but they will tax 50% of your benefit, and they'll add that back up to your income stream. Isn't that ridiculous? They're going to tax 50% if you're just showing $32,000 of income and you don't deserve all of your Social Security. I'm quite opposed to that personally. So let's move to bucket number 3. This is the tax-free bucket, and there's only one example, and it's muni bonds. If you have $80,000 of interest from a double or triple tax-free muni bond, your tax bill is zero. So you're actually left with $80,000 to spend in spendable income, which means you still had yet another increase. There's a sales pitch for those as well. Right now, even though it's tax-free, the $80,000 goes on your return on your 1040, and I believe that's so. Well, I mean, it is. It's so that they can use it against you, right? Because if you have $80,000 on your return, the government's going to tax 85% of your Social Security again. And if you're married today, you got to pay about $800 a month in Medicare because you have quote-unquote other income. So this still didn't accomplish what you said you wanted, which was control the knife. So bucket number 4. This is the tax-exempt bucket. And let me first define by what I mean by tax-exempt. Any distribution is tax-free, just like bucket number 3. So if you used $80,000 from this for income, then your spendable income is all 80 of that. Now, what makes this different is the distribution. The distribution from this is not means tested on your Social Security or any other benefit for that matter. It doesn't hit your 1040. So this means that regardless of how high this is, and regardless of the state that you reside in, if you don't show anything on your 1040, then there's nothing to means test. And you'd be able to have 0% of your Social Security taxed. So you can actually receive 100% of it. Plus you only pay about $100 of Medicare instead of $800, and you qualify for any government cheese that exists. Now there's only 2 products that fit in all the tax code in this bucket here. First is the Roth. Now, what's interesting to me is the distribution from a Roth generates what's called a 1099-R. And why is that? Well, I believe it's the Internal Revenue earmark so that at some point they can convert these to the tax-free bucket in order to means test them on your Social Security. It'd be really easy for them to do because for now it's tax-exempt. I mean, it doesn't means test against your Social Security. However, the government disqualifies high achievers from this opportunity. If you make like $120 a year of income or above, you get to be phased out of contributing to a Roth IRA, and that's fascinating to me. They're not promoting tax-exempt products to high achievers, right? And that's because they want to get you over here. But even if you do qualify, they limit to your contributions to roughly $5,000 a year. So even if you qualify for these never can develop a large enough balance that's going to really create an account for you that can last you getting down the mountain for very long. You just don't have much money. So they just qualify from you. They just qualify you from it from an income standpoint. And then for those who do qualify, they create very limited amount of contribution limits because they're pushing for money into these buckets. So the government allows me to do over $50K into a SEP IRA, bucket number 1, but $0 over here. Well, that's just interesting to me. They know who they want to get their taxes from, and this is what they promote, right? So they don't allow high achievers to contribute to these, but they encourage us to put all kinds of money into bucket number 1. So the only financial product that is remaining is permanent life insurance in the tax-exempt bucket. Now, when you hear the phrase permanent life insurance, have you typically had positive thoughts, right? I want to ask them some questions. But my guess is you haven't seen them in this light, is my guess. Now, the reason people haven't heard about or seen this is really primarily because about 4% of all these policies are really the heavily funded permanent insurance policies. And who makes up this 4% is what's interesting to me. First of all, it's the banks. Banks have more of this than any entity on the planet. And as a matter of fact, they make up almost all of this 4%. As of March 22, Bank of America has over $24 billion into these in cash in their life insurance reserves. And that's public record, by the way. It's line 41 of their assets and liabilities report on the FDIC.gov. Over the past 11 years, they've increased 68%, increased their holdings. Chase, 62%. Wells Fargo, 297%. Right? It's referred to as their Tier 1 capital. And it's their Tier 1 capital because of how they use it. I'll show you that here in just a moment. Next, we've got the government, our politicians. As an example, I've got a colleague who helped a current sitting senator set up a life insurance contract where he contributes $500,000 a year into his insurance. There isn't a contract on the planet for him that actually costs $500,000 per year. He's funding it to the tune of $500,000 a year. He is shoving cash into this thing. The last group is the wealthiest. History is riddled with successful, wealthy people who have had or used life insurance. So what do banks, politicians, and the wealthiest know how to do better than most people? Yep. They know how to plan and how to control. They know how to keep control of the knife, for sure. So all of these products on these buckets are great for accumulation, right? But what we can't stop at accumulation. When it comes time for distribution, we try to move money as far as we can because of the benefits for coming down the mountain. So this is literally what I do. I create this fourth bucket. I take a look at the money you're currently forwarding to the first three buckets and see if it makes sense to direct anything to create that bucket. But just like climbing the mountain, it's not effective to determine this when we finally get to the top. To get this right, we have to implement this piece early and have it while we're climbing. We have to be ready to turn that corner